Welcome back to the Crypto Alpha Network. Before we head into today's alpha, do us a huge favor by liking this video and clicking on the subscribe button. We'd love to hear from you, so don't forget to leave us your thoughts in the comments below. The SEC just dropped a bombshell, with Paul Atkins defining what constitutes a security transaction in decentralized finance. Specifically, he clarified what does not classify as a security transaction, essentially providing a clear indication that decentralized finance will be big moving forward. Many speculated about this, but now regulators are giving the green light to what Wall Street has long desired, staking in their Ethereum ETF products. But other than Ethereum, which projects will benefit the most from it, the market is green overall. BlackRock, with $11.5 trillion in assets, has said that wealth advisors are only beginning to explore Bitcoin, hinting at substantial growth ahead. But we already knew this. However, the market feels stagnant as Bitcoin nears its all-time high. It may seem odd, but buy and sell pressures appear to be balancing out as we saw yesterday. A few weeks ago, we discussed the many shorts poised for liquidation at higher levels. Although more remain higher last night as Bitcoin hit $110,000, it triggered $439 million in liquidations. Overall, Bitcoin is showing strength, and some analysts are talking about this inverse head and shoulders pattern with a target of roughly $150,000. Historically, when Bitcoin breaks structure on a higher time frame, it tends to go parabolic. If it does so soon, it will align with the M2 global money supply chart it is still tracking. So we could soon see all-time high breakouts toward $140,000. After all, with so many new Bitcoin treasury companies emerging, one might argue that fair value isn't being achieved. Now, onto something that will interest the degens a little more. Yesterday, June 9th, 2025, the SEC held its final Crypto Task Force Roundtable, Decentralized Finance and the American Spirit, focusing on decentralized finance regulation. SEC Chair Paul Atkins announced a shift toward supporting decentralized finance innovation, criticizing the previous administration's enforcement-heavy approach under Gary Gensler. He said self-custody of crypto assets is a foundational American value that should persist online, stating, "The right to have self-custody of one's private property should not disappear when one logs onto the internet." Atkins advocated for greater flexibility in self-custody to reduce transaction costs and enable on-chain activities like staking, rejecting claims that software developers creating self-custody tools should be treated as brokers under securities laws. He directed SEC staff to explore guidance or rulemaking, including a potential innovation exemption, to ease regulatory barriers for staking services on decentralized finance platforms, aligning with President Trump's vision of the U.S. as the crypto capital of the planet. Paul Atkins explicitly stated that these are not securities transactions. First, mining. Second, validating. Third, staking as a service. You can see where this is heading. Ethereum bulls have their ETF products, but they now want these to include staking services. The SEC statements point to this being fully permitted once properly regulated. Staking in ETFs would be akin to investors receiving dividends from traditional stocks, as they would earn rewards from their staked assets. That is, assuming the ETF products pay investors accordingly. This is undeniably bullish for Ethereum. Meanwhile, Ethereum ETFs have seen consistent inflows recently, while Bitcoin has experienced many days of outflows. And many may not know that Ethereum is closer to its all-time high than Solana is. Let's also note the recent upgrade allowing validators to stake higher amounts of Ethereum. The validator queue on Ethereum has since surged dramatically. Could these SEC moves have been influenced by major Wall Street players preparing for staking in their products? Take that with a pinch of salt, but it's not implausible. Ethereum staking has reached an all-time high, with nearly 35 million Ethereum locked away. As Ethereum saw a 40% pump in May, and the ETH to BTC ratio is holding against its downtrends for the first time in a long while, this narrative is generating excitement. We should focus on protocols benefiting from this, beyond Ethereum itself. Combined with the current hot narrative, stablecoins, this points to decentralized finance as a key beneficiary. The Genius stablecoin bill, which regulates stablecoins by requiring issuers to back them with safe assets like U.S. Treasuries, is being voted on by the U.S. Senate tomorrow. Linking these two stories shows us that decentralized finance will likely be a major beneficiary, along with some Ethereum betas, of course. In closing, the SEC has become highly crypto-friendly, and this move toward decentralized finance-friendly regulations may have been influenced by Wall Street heavyweights with their own ETF products. Whatever the case may be, the landscape is bullish for Ethereum and decentralized finance, as well as the blockchain and crypto industry as a whole, with clearer regulations. But let's identify the projects that will benefit most from it all, beyond Ethereum. Is it time to buy decentralized finance? How many have given up on the natural flow of capital in crypto, which typically moves from Bitcoin to Ethereum to large-cap coins, then smaller ones, before a bear market? Well, there's reason to believe that since Bitcoin has risen over the past year, and now Ethereum seems to be following, this rotation hasn't stopped. And that's great, because Ethereum is where decentralized finance currently lives, for the most part. Everything is falling into place. Now let's look at which projects might benefit the most from the decentralized finance narrative. Aave is a decentralized finance protocol on Ethereum and other blockchains for lending and borrowing crypto. Users earn interest by supplying assets, borrow with collateral, use flash loans, and govern with the Aave token. It is the leading protocol in terms of active loans, with over $16 billion borrowed currently, compared to just $15.06 million on this day in June 2020. Aave's founder also recently met with Bo Hines at the White House to discuss protecting decentralized finance innovation in the US. Aave's price mirrors its total value locked. With growing institutional adoption, we can expect a pricing catch-up. Ether.fi is a decentralized, non-custodial staking protocol on Ethereum. It allows users to stake Ethereum and receive Ether.fi, a liquid staking token, for use in decentralized finance for yield farming or liquidity provision, while still earning staking and restaking rewards. ETHFi is the governance token, enabling holders to vote on protocol decisions. It enhances staking rewards through eigenlayer restaking, offering multiple reward streams while maintaining security and decentralization. But it goes beyond just that. The project offers Ether.fi Cash, a non-custodial Visa credit card and mobile wallet allowing users to spend crypto, for example USDC, Ethereum, or borrow against staked assets, for example Ether.fi, at 0% APR for real-world purchases. It provides 5% cashback, earns 5 to 10% APR via decentralized finance vaults, and supports Apple Pay, Google Pay, and global payments. Ether.fi Cash is currently still in beta with a waitlist. Could this be the start of things picking up? Is it the beginning of a rotation from Bitcoin to Ethereum, followed by large-cap coins, mirroring the capital flow seen in previous bull markets? It won't be long before we find out. Expect midweek volatility with CPI and PPI releases and whispers of a US-China deal surfacing. Before you go, help us increase mass adoption and get the word out there by liking this video and clicking on that subscribe button. We'd love to hear from you, so don't forget to leave us your thoughts in the comments below. Bye for now.